9th of April, a stunning announcement by President Trump of a 90-day pause on tariffs. What should we do? Firstly, let's recognize that it's not over. Protectionism that's unstable is the type that will cause the most uncertainty and the largest swings. If you're already invested and you're in it for the long term, stay invested, stay diversified. There's no need to sabotage your future self and your life goals. If you're not yet invested and considering further investments, do reevaluate your risk. Not the risk of the markets, but whether you are going to have that job and that income. Build a cash moat, a cash buffer for yourselves, and drip in. In other words, invest slowly and dollar cost average, and don't rush all in to chase whatever is happening. For retirees and near retirees, we need to adjust this approach. Shift some of what you have to something safe so that you can fund your near-term needs. And for everyone, we need to belt in, be prepared for rough waters, and also tighten our belts. In other words, spend less. So, hello everyone. Here we are again with a part 2 of how to respond to the amazing event of the US tariff. Once again, a reminder that this presentation is for information and training and does not take into account your own investment or financial situation. So last night, around 1 a.m. Singapore time or 1 p.m. Eastern time in US, something very dramatic happened. President Trump tweeted, and then there was a press announcement that the US would put a 90-day pause on tariffs for about 75 or more countries who had come to negotiate with the US. Everyone will be enjoying, in that sense, if you can call it an enjoyment, a reduction of the baseline tariff to just 10%, except for China, whose tariffs are up to 125%. But there was quite a bit of positive noise. President Trump said that even China actually wants to make a deal, just didn't know how. And every single country they will make a deal with. Europe's earlier that day had announced that there will be tariffs on some US goods, which seemed to be aimed at hitting the areas in the US that were Trump's constituents. However, later, after the announcement of the pause, they signaled that they will be open to talk as well. In the markets, this caused a huge gyration upwards. And we had the best one-day gain since 2008, the global financial crisis times for the S&P 500. The Dow was up almost 8% and NASDAQ up 12%. US bond markets, they were being watched very closely. Now, I've said many times that usually the stock markets don't keep me up, but this time the bond markets have been keeping me up, and I'll explain why. So what happened in between our part 1 of what we talked about on so-called Liberation Day with the announcement of tariffs and the pause yesterday? On Friday, 4th April, the US non-farm payrolls showed strong data. As I said in my last video recording, this is not a leading indicator. This is at most a coincident or a lagging indicator of the economy. But nonetheless, the payrolls were much stronger than the forecast. Federal Reserve Chair Powell came up to signal concern over tariffs lifting inflation and slowing growth, the double whammy. Oil yesterday touched a level that was 4-year low below $60, although now it's crossed back above. The most dramatic thing that everyone was very nervous about is the bond market. The US Treasuries sold off. Sold off means that you see yields go up and price go down. And the 10-year US bond yield actually had really spiked up from a low of below 3.9% last Friday to over 4.5% before crossing back to below 4.3 this morning. And we saw that the US 30-year fixed rate mortgage, which is priced off treasuries, hit a high of 7%. So during this time, there was a lot of uncertainty in the market, a lot of questions about why are bonds doing this, what's going to happen. And President Trump actually came out and said, be cool. He could possibly be a financial advisor. He said that everything is going to work out well. And that was what happened yesterday. And indeed, at the end of the day, we saw that markets were really up very, very strongly. So did President Trump flinched because of the markets. I think there's something about bond markets. There's a quote here at the bottom of the screen when a previous political advisor said that, if he could be reincarnated as something powerful, he would really want to be the bond markets because bond markets can intimidate everyone. And we know from 2022 in the UK, for example, Prime Minister Liz Truss' reign was quite short-lived, and that was a lot to do with the UK government bond market or the gilt market. The latest Treasury yields are still high at 4.27% for the 10-year this morning when we checked, and the 30-year bond yield is over 4.6%. Why did this happen? So that was also the question that I was asking many of the investment professionals. You see, bond markets are really scary, and bond markets are where we find many, many signals where there can be systemic stress. And we used to have a joke in the investment circles that say the people who react the fastest are firstly the currency people who just buy or sell. The people who are most optimistic and somewhat delusional are the equities people, and the fixed income people are apparently the smart ones because they are always obsessing. Jokes aside, we look at the bond markets. The bond markets are huge and they are the foundation of so many things in today's world, in financing, in payments, in banks. So was there a flight to safety because of the underlying fear of stagflation? Fed Reserve's chairman's dilemma that he highlighted meant that there might not be rate cuts or might not be so soon. In fact, on Wall Street, amongst the banks, there's a huge dispersion in terms of like how many rate cuts are they anticipating. After the tariff announcement came out, some said 0, some said 4, and that's how uncertain things are. There's quite a little bit of news about this hedge fund basis trade. It was basically that you hold some treasuries, but you sell many, many more times the synthetic swaps. It's a bit technical, but what happens is that if people are unwinding these trades, they need to sell the underlying security, which is the treasury, and this could have caused treasury yields to go up. So this was also a question mark. And the risk for markets here, or the risk for the system, is there big exposure by banks to these hedge funds with their leverage trade? As you can recall, Credit Suisse troubles started because of the exposures to hedge funds. And even in 2008, the first sign of stress was in Bear Stearns, which also had hedge fund exposures. Thirdly, whenever it comes to the bond markets, there's a question of whether there's dysfunction and could this lead to a banking crisis or a credit crisis. If you have to refinance and the basic government bond yield is up, then you have to refinance at very much higher cost to you as a company, and this can cause credit stress. Finally, there was a lot of question or fear or speculation that it was about the foreign holders of US treasuries like China dumping treasuries as a kind of retaliation, as a kind of new like theater in this whole trade war or tariff tit for tat. Because if US bond yields go up, then what President Trump had promised, that there will be lower mortgage rates, that there will be cheaper borrowing, or you have to solve the debt problem, that will not come true. So in our assessment this is probably the least likely. We still do not know exactly why things have happened, but we do know that indeed there is uncertainty, and this has not cleared up yet. So just a very quick one, because there's quite a bit of talk about US and whether USD is being rejected as the reserve currency and this whole risk of foreign selling. Now, the good thing is that at the 1 a.m. auction of the 10-year US bond yield, the flows did not show a huge foreign selling. There's a way of telling this. There's something called the indirect bids for US Treasury in every US Treasury auction. The auction was very strong, and you still saw indirect bids, i.e. coming from overseas, at about 87% of the bids. I think we need to be quite realistic that the US dollar holds a very, very big proportion of foreign reserves worldwide, or rather foreign reserves are largely held in US dollars. It has come down over the years, and even China's holdings had come down from over 1 trillion to now about 760 billion, as you can see from the table on the right. But it's not in anyone's interest to play this game of trying to dump the US treasuries very quickly. Well, firstly, the rest of your savings, the rest of your reserves are going to go down hugely in terms of its value, and there are a lack of alternatives in the short term. People are saying that maybe you should buy German bunds because that's seems to be where there's some value, or you can buy gold. But there's not enough, honestly, of this in the short term to buy. Chinese renminbi itself is still just over 2% of all foreign reserves. So it could very well happen. Of course, if the US is not trading with the rest of the world, then actually there's not much demand anymore for US dollars. And this is really where people's US dollars come from. So in the longer term, there could be a new equilibrium and a repricing. But these things take quite a long time. When the sterling pound also lost its reserve currency status, it took quite a bit of time as well. So something to watch. I think overall, what we are seeing in the bond yield market could be a technical issue with regards to trading positions, but fundamentally, the risk of stagflation is something that bond markets are looking at, and that has not cleared. And therefore, we think that as far as the markets are concerned, it's not quite over yet. Even in the politics side, it's not over by far. Yes, we had a reprieve, but the big guys are not sorted out. And there's this game of chicken there. China had said fight to the end. And of course, there was the escalation. There was 104% one side, then there was another 54% one side, and I've lost track of the numbers. I think now it's 125 on China. Europe had come out to place the tariffs, but Europe actually buys mainly only tech from the US. So will there be anything there? Now we don't know. There could also be a regulation fight, so it's a multi-dimensional issue. China has an unreliable entities list, for example. Will there be any further capital market fight? Though I had said that I don't think that people risk that, but you can never tell. And what President Trump said was that it's more than 75 countries, and they'll make a deal with each country. How does that work? That sounds like a lot of work to do. Will it be settled anytime soon? And I think it's a hiatus at best. So what do we actually need to see for a little bit more confidence, or what can we maybe, I would say, expect to see? We need to see a prototype of a real agreement, be it with Vietnam or with others, that can then be replicated among the other countries. We need to see face-saving moves. This is important for the big powers, the top leaders of both. We had this Trump and Kim summit here in Singapore at Archipelago. Will there be something like this? Would that enable both sides to come down? But the base case remains, as I said in our first recording, our first video last week, lower growth, higher risk of recession across economies is still the base case. I see this as a reprieve and not a resolution. After all, President Trump himself said it's a pause for 90 days. And as PM Lawrence Wong said in his ministerial statement a few days ago, protectionism is already bad, and especially for Singapore. Unstable protectionism is worse. Because for businesses, we don't know what to do. You will hold back. Will you invest? Would you hire more people? That's highly unlikely. And therefore, all the stresses that we talked about on prices, on jobs, on growth, all those vicious cycles, and perhaps even on financial markets, these are still things that we need to watch. For investors or even people who are looking to the markets for signals, it's very tough to invest in these times. And if we enter a bear market, which is about 20% down by traditional definitions, but I don't think we need to really talk about defining this. We just know that it's very volatile and quite different from what we have been experiencing over the last, say, 5 to 10 years. The main challenge is that when markets go down like that, we can't tell how deep they would go down and how long these dark days would be. These are the times when we had market declines of 20% or more, compiled by dimensional fund advisors. And we see that the worst one, the Great Depression, which is also when we had our last trade war, we had a maximum decline of almost 84%. How scary is that? And it took a very long time to recover. In my last recording, we talked about, therefore, if you have 15 years, you could, and you were back then, you could weather this. But there is, of course, a lot of fear in between, and whether you have the wherewithal, your ability, and the risk appetite to ride through. The other ones, well, there's so many. There are some that only took a couple of months. There are some that took years. But overall, I suppose we take some comfort that of these 16 bear markets since 1929, in 9 of them within a year, you would have made back your losses. But this is not a prediction of what it would be this time. So when you invest in volatile markets and bear markets, it's somewhat different. We need to adjust our strategies. And a lot of these strategies is not about the market. It's not about the stocks or what you should buy, but it's really about tempering all these considerations, or rather combining them with financial planning and psychological self-management strategies. So let's go through the 3 groups that I would like to talk about. If you're already invested, as we always say, stay invested, stay diversified. It's about the time in the market and not about timing the market. But what about your future monthly investments? What if you're not yet invested? You have some cash. What should you do? Now, here, a lot of times people say, what should I buy? Should I buy this? Should I buy that? Should I pick stocks? Should I buy bonds? May I suggest to you, it is not about what to buy, but how you go about buying it. The first thing you need to do is reevaluate your risk. I'm not just talking about your risk appetite, but your risk appetite as defined by whether you are going to continue to have a surplus, whether you have your job and whether you have that income coming in. The second thing you need to do is to build cash buffer. And the third thing is that whatever the math says about investing as early as possible, that still stands. But in these type of markets, you need to drip in. You need to do dollar cost averaging. You need to tranche it out at a minimum rather than try to catch a good time to go in. For retirees and near retirees, it is interesting. It's not about the buying side. It is about when and how much you need to sell, because as retirees, you do need to withdraw. So here we talk about the concept of immunization, which is to stabilize the value of your portfolio, or at least part of your portfolio, and withdrawing less. Allow me to go through each of these 3 groups now. If you're already invested, stay invested and turn off your TV. Don't watch CNBC. I'll watch it for you. It's very, very scary, and I actually sometimes term it to be financial porn. Why don't you be sleeping beauty, go and sleep and wake up later? You will not have missed anything. We talk a lot about catching the falling knife, but if you're already invested, this falling knife doesn't hurt you. In fact, it only hurts you if you allow it to cut into your plans. And missing out on the up days, as I shared in our previous video, actually cuts down your life goals. Yesterday, 9th of April, was one of these best days that if you missed, could hurt your portfolio value. And when do these amazing days come about in the markets? They always come when the fear is the highest. If you're already invested, you also should be invested in a diversified manner, major in diversification and minor in stock picks. Here is a chart of tapestry of every year what asset class or what slice of the market outperforms. You can see there's really no pattern. Sometimes it's the big caps, like in the last 2 years, S&P 500, the Russell 2000 is actually small caps, comes a bit further down. There is a case for diversification because you really cannot predict. And so we really recommend that you stay invested so that you always don't own the worst losers and always own some of the top winners. So that's what we always say. But I would like to offer a financial planning or financial advisor's perspective. And I'm borrowing from Morgan Housel, the best-selling author of the book called Psychology of Money. There are a lot of things that you can say that are totally rational. I've shown you charts, I've shown you annualized returns, long-term returns, and that is totally rational. But in individual investing, we are all human. We need to accept that something might be reasonable, but not totally rational, and it might be preferable to being coldly rational and unreasonable to us of ourselves. We are human beings. We can keep cool, but we are not cold-blooded. And a trade war or the threat of a trade war is also a war or a threat of war on your mind and your emotions as an investor. And so you need to know how to deal with that. So therefore, may I suggest, perhaps against the math, that if you have that time horizon, you do have that capacity, theoretically, but you're really, really scared. In other words, when you did your risk profiling, you actually got it wrong. You don't have that risk tolerance to ride that roller coaster of a equities market. Warren Buffett said that if you really want to buy something, you should be able to accept a 50% loss. But perhaps that is not really you. And there's no shame in that. You can, if it helps you, move a portion, 10%, 20%, a minority of your portfolio to a money market fund during this time, or to a lower risk portfolio with more bonds. This is not a investment calculation. It is a mental hack because it is superior to selling everything if it goes down further. So you could take advantage of any bounce in the near term these few days to make that movement. It's not something that we often say, but we want to temper this with some reality of self-management. We temper our staying invested evergreen principle with this reasonable thing to allow ourselves to do if we know ourselves and we know that we have a risk of falling to our proverbial death in the investment experience if it goes down further. Now, if you want to sell more than just a small portion, well, then please ask yourself first, what is your buying back strategy? If you have no buying back strategy, best is to still stay invested. Quickly on this part again, please don't misunderstand that I'm asking you to shift your asset allocation if your goals have not changed. But what I'm saying is that the main thing is to stay invested. Stay invested. If you can in what you already have, if you can't, then stay invested at least part of it in something that will give you that long-term return. Well, if you're not yet invested, what should you do? We need to start with you. Don't start with the markets. Don't start with what is happening there. Start with your goals and your risk appetite because that's the way to win. Reevaluate your risk ability. On the right, you see actually Money Hours risk profiling tool, which you can find on our Invest page or our account opening page. We don't sell anything anymore, Money Hour, but this is the tool that we can recommend for you. Now, we talk about the ability to stay invested. It's always about time horizon. So if you have a 30 years time horizon, actually, you have no need to participate in the fear of the markets in the short term at all. However, your time horizon, which is your risk ability, has some variability about it as well. Your time horizon is actually at risk. And this is the risk that I'm asking you to evaluate, which is what is the risk that you would lose the source of funds for your long-term investment, which is your job or your income. The main problem in the tariff war is actually the economy. And if there's a job income loss, you should not continue investing because you need to safeguard cash. Cash becomes precious. So please evaluate this. When I started work in 1997, that was the Asian financial crisis. And I remember because I was in the government, I started a government job, and there was a lot of uncertainty around and all that. But for me, it was not an issue because I just started work. Yes, there wasn't much of a bonus, but I never had one anyway. Now, come 2008, I was in the financial industry in investments, looking at banks, and it really felt quite scary because if every banking crisis, every financial crisis, part of the financial industry goes away and never comes back in terms of their jobs, in terms of the roles. But I remember then meeting my ex-colleagues from the government, and they were quite chill. So again, reevaluate your risk, your ability to take risk. Our jobs are not equal. We are subject to different parts of the cycle. There are pros and cons, of course, to every job. So please reevaluate your risk ability. Now, if there is that risk, what do you need to do? You need to firstly build more of an emergency fund. Advisors have been saying you need 3 to 6 months of emergency fund. We have always said a Money Hour. Let's stretch that a bit to 6 to 9 months because the job markets are not so simple nowadays. And in this situation, I would say even stretch it to 6 to 9 months. Build that. So instead of trying to look for companies to buy that have a good moat in terms of its economic moat, in terms of how it makes money, build your own moat first. Because that moat in terms of investments can still in the short term be invaded. You need to do is to build your cash moat, your cash for yourself, your cash cushion for yourself. There's a lot of talk about buying the dips and all that. And actually, we are not talking about buying the dips. Obviously, yesterday there'll be some people say, "Oh, I made a good choice to buy the day before and all that," but that is not what we are talking about. Buying the dips in a bear market can turn out quite wrong. That's why people talk a lot about dead cat bounce or catching a falling knife. But what we're saying is that you drip in and you do a dollar cost averaging. Now, this is not so much again about the markets or about how returns work, because if you're buying and holding and you know that markets recover and go up over the long run, actually most of the time lump sum investment is better. But this is to risk manage your situation, the potential that your time horizon is cut short because of the job loss or income loss. So it's not about the markets, it's about you. And I want to make a point here about how you invest, or rather the instrument in which you invest. There are investment linked policies, there are insurance policies that have a very small insurance element. They are basically unit trusts with that insurance wrap. There's quite a lot of talk about this. It has been very popular in the last few years. I am not a great fan for various reasons, but for now, I would really recommend that you do not buy these if they have penalties, and I think most of them have, for missing premiums, because cash can become precious in times of job loss, and you don't want to have a situation where you have to pay penalties because you're trying to keep up with your premium payments or your investment payments. So this is the recommendation for those of us who are not yet invested. For retirees, bear markets pose a very specific risk if you're depending on withdrawing from an investment portfolio to fund your retirement. It's about time horizon, yes. And then after the last recording, we had someone ask, "I'm a retirement 70 years old, so is my time horizon short?" Now, actually, from the time of 70 to life expectancy point, which in Singapore is about 85, you still have quite a number of years. And if you're retiring at 65, maybe you have 20 years. But a retirer's 20 years is not the same as an accumulator's 20 years for various reasons. Firstly, you can't really tell whether it's 20 years. There's potential of longevity risk, and this means that you need to be able to handle your portfolio in a way that can last as long as possible. The second is what we call sequence of returns risk, and this is whether when you start withdrawing, markets go up first and then come down later, or they go down first and then come up later. The risk here is that you may deplete your portfolio, you might run out of money. So allow me to illustrate this. This is a portfolio that has a starting value. You invest $100,000 over 25 years. And let's say you start at age 41. There's portfolio A, which is, or rather is an experience A. So let's say that in this portfolio A, in this particular universe, it ends with an 8% annualized return over 25 years, but it starts with the markets going down 12%, 21%, 14% before rebounding. The average annualized return is 8%. In portfolio B, it starts with markets going up, coming down, but the average annualized return is still 8%. Now you see that for an accumulator, i.e. you just put in 100,000 and you ignore it for 25 years, in both universes, let's say you have in the parallel universe of portfolio A and parallel universe of portfolio B, there's no difference to the end portfolio value. But let's take another 25 years and you put in this end portfolio value into the same experience. Let's say history repeats itself. It's a Groundhog Day in both universes. In portfolio A, you start to withdraw and you inflation adjust as well so that you can fund your retirement needs. You find that portfolio A runs out of money after you're 80 years old. But your counterpart in portfolio B, in that alternate universe, still has a legacy at the end of 90 years. So in accumulation, there's no difference, but there's a big difference in retiring. This is the difference in time horizon between an accumulator and a retiree, and this is called sequence of returns risk. Why does this happen? Because when you withdraw and the market comes down, when it rebounds, you're actually starting from a much smaller pot because it has all been lost. And so you need to make back so much more and it is not always possible. So what do? If you're starting to withdraw, take advantage of any bounces now and withdraw some lump sums needed for maybe about 2 years or so. You can do it in tranches and keep it in safe places. You can keep it in cash or Singapore savings bonds. So you can, of course, withdraw more, but it depends also on how much your portfolio is up or down. But you withdraw more as in terms of the lump sum. But in terms of the percentage that we withdraw for income, you should withdraw less. That's the second point. The second point here is not about immunizing the portfolio, the lump sum, but the second point here is about how much you spend out of your portfolio, how much you sell down every year or every month. Or don't use your investment portfolio for the purpose of funding your retirement. You can use other sources. For example, CPF, where there is no risk of a down year in that sense. I'll show you that a bit later. Now, the rest of your portfolio should remain invested, but the maximum risk that you can take should be that of a balanced fund. Now, for near retirees, if you're say 5 years before retirement, what you can consider doing if your portfolio value is a sufficient amount now is to immunize it. So you can actually lock in the value of your portfolio now. You can move it to safety, or you can consider something like CPF retirement account if you're before 65, for example. And we always recommend that you have at least the full retirement sum in your CPF retirement account. The CPF life payout should form every Singaporean's safe retirement income floor. It's that base. Why is this so? Because CPF life is, firstly, it's for life, so it hedges longevity risk, and it gives you a high interest of up to 6%, and it doesn't fluctuate. So it's very reliable. And for the income that you really need to fund the needs that are non-negotiable, your basic living expenses, you need to have reliability. And so CPF Life is the best when it comes to this. And what is this kind of instrument called? It's called an annuity. It's an insurance instrument in the sense that it hedges longevity risk. And what we have here is in the table is your retirement balance, and the three BRS, FRS, and ERS are the basic retirement sum, full retirement sum, and enhanced retirement sum. These are not thresholds, so it's not like all or nothing you have to hit, otherwise you don't get anything. These are just reference points that if, for example, you have $106,500 in your retirement account at 55 years old and you're 55 this year, then it will grow, this sum will grow in your retirement account over the next 10 years to $168,452 estimated. And from 65 years onwards, you will start to get a CPF life payout. And just by looking at the percentage of what is this so-called yield, right? Your payouts over your capital sum, it is over 6%. Now, this is very hard to get, and when it's very stable, but yes, it is a decumulation of sorts, because this decumulation means that you, depending on when you pass on, your capital is not intact. That is actually a drawdown. But for most of us, we cannot just live off income, because that would mean that you need a lot of capital to start with. So I won't go into this. We do have a recording of our CPF webinar, but just want to suggest to you that for all retirees, instead of looking at investment withdrawals, you can consider this as an alternative. In fact, we recommend that CPF Life be your base. Another tool, of course, in such volatile times, you can consider also working more and then using your CPF to just accumulate more and more payout. For every year that you defer withdrawing, you actually get a 7% increase. But this is just for your reference, and is as an alternative to how you can generate a good income even in volatile times when your investment portfolio might not be able to perform that function as well. Okay, so I'll just summarize here that the Chinese have a saying that from 孙子知己知彼百战不殆, and this is from The Art of War. It says that know yourself and your enemy and you'll win every battle. So what is yourself and what is your enemy in this context? Because you need to know also the environment, that what is the real concern here is still the economy, it's not the markets. You need to combine staying invested discipline with that reasonable self-management, because investing success is really about your behaviors and your mindsets more than what's happening in the markets. You can't control the markets, but you can control what you do. So for new investments, as we said, reevaluate your risk, Upsize your cash buffers, dollar cost average in, not all in. Don't try to catch the bottom, because most of us are quite greedy and we say, oh, we want to catch the bottom, but you really can't. And markets always turn before fundamentals turn. For retirees, more cautious approach, use CPF as a safe retirement floor. And for all of us, we have to be prepared that this will go on for a while and you need to tighten your belts. Knowing yourself is about focusing on your goals. What do you really want? Take this time to reevaluate what are your goals, what are your needs, what are your risks. Once you know what your goals and your needs, you can beat the enemy. And what is this enemy? The enemy is actually the fear and greed that comes in volatile times. So thank you very much, and keep well, keep the faith, and let's get through this together.
Okay, thank you so much for that, Shanting. I think that was very insightful for all of us who woke up a bit frenzied with the news that happened. So you mentioned US Treasury yields, right? But I'm not very sure what rising bond yields mean for me and why I should be concerned about it. And let's say for a regular investor, if I want to invest in bonds, isn't higher yields better?
Yeah. Thanks, Vivian, for that question. There's a understanding of bonds and the access to bonds is something that maybe we need to do more education about. Indeed, if you buy a bond directly, for example, you bought a US Treasury bond, a 10-year Treasury bond, and you kept it, then of course you just collect that 4+%. It sounds very good, right? Yeah, do that. But there are a few issues with that, right? Firstly, is that can you access those bonds? In Singapore, you would be looking at using Singapore bonds, because if you take the US bonds and you buy the US bonds, you're actually taking currency risk. And so that risk is probably more than what you should be doing when you buy a bond. So what happens is that for most of us, we actually access bonds through a bond fund. When a bond fund, when you put it into your portfolio, a bond fund has a price. Because what happens when yields go up is that let's say I'm US Treasury, I'm issuing a bond and the bond is priced at uh, $100, but then the yield is the coupon says 4.5%. What happens to the other bonds that were issued, say, last month, for example, and that coupon was, say, 4%? So to make it equivalent, the price will go down. So when the price goes down in a bond fund, that is marked down, is marked to market. So you will see, as a regular investor who buys bonds through a bond fund, that the value of your bond fund will go down. So as a result, because of that mark to market, you won't experience that idea that I don't have to bother, I only need to bother about the income. Because it's the nature of bond funds versus buying individual bonds. That when a bond fund, there's something called a price. When you buy the bonds, as long as the bonds don't default, is that you can just collect the coupon. Now, but what's the problem with them buying individual bonds? Because most bonds come in quite chunky sizes. In Singapore, in Sing dollars, especially, they're not very much available for high quality bonds. And they come in like 100,000, 250,000, although there are places that fractionalize these bonds. That comes with its own risk with the counterparty. Ultimately, you're taking more concentration risk. Bonds are quite binary. It's like Credit Suisse, right? When it defaults, well, it's all gone. Most of the time, people feel that bonds should be safe. But if you're putting like all your retirement savings or all your savings into just a few counters, you don't have that benefit of diversification. Yeah, so it's a little bit complex on this, but so that's from the direct investing in bonds point of view. I want to have another note of caution about bonds, that you don't just look at yield, because when the yield is high, sometimes it's because it's a risky company. For example, so high yield bonds are also called junk bonds, and there is a reason for that. The worry really about bond markets, why is it that the investment people are just watching it? It's really about dysfunction. So bond markets underpin the whole financial system, and that's why we're worried about it. So when bond yields rise to very, very quickly and very sharply, this is where we have a problem. So I think yesterday we managed to sort of avert any of that, but it still bears watching for this reason.
Thank you so much for that, Shanting. So the second question I have is, you've talked about global markets and staying invested, but what if I'm invested in SGX stocks? For example, ST jumped, and I think DBS is also up around 10%. So do those same principles apply to Singapore stocks?
Yes, it's a no. Right. So I think for staying invested, the principle is that if you're staying invested in something good, that's what you need to do, and it'll be okay. And over time, you will reap that return. I'm not saying that DBS is not good or OCBC is not good, and they're proven to be very stable. They call them blue chips. I would say let's approach it again from you. What are your needs and why did you get invested in them? If you are, say, a retiree and you're looking at dividends from them to fund, as long as nothing happens to these banks, you can hold on to them and nothing happens to STI, then yes, can use that as a good source of income, and but what you trade off is a concentration risk. In the STI, the index only really has 30 stocks. In the global index, you're talking about many, many stocks. The same principle applies that if you will always hold some winners and you always hold some losers, but you try to pick the winners, then you might be in for some pain, especially in the short term. Uh, so if you're looking at the portfolio and you only have a few stocks in there and you were trying to pick them, I think a lot of people are saying that, oh, let's go on into Nvidia, let's go into Apple and all that, then you will have something. So you have to see how much conviction you have on these companies that you're buying, that they will be there for you in terms of the returns. What we know most reliably is that the global diversified portfolio is the so-called only free lunch in finance, where you don't have all this systemic risk and you can still get a very good average short-term return. So I wouldn't say that you should sell them. You should understand that there is a certain cycle that goes with the Singapore stock market, because heavily in financials and property, and these two are very linked. We need to uh, basically uh, we have that conviction to hold on, but maybe over time, slowly again. In these times, it's all about slowly. You can consider shifting some to a globally diversified portfolio where we have higher reliability and more speed.
I see. So it's like what you said just now in the webinar, to slowly drip in and don't just wait for the dip and to buy.
Yeah, I think that's the main thing about that resilience in a volatile market, especially if it's a bear market. That don't try to match speed. There's no need to be a hero in such markets. In fact, what you should do is to be slow and steady, and and everything can be slow. And when it comes to this, yeah.
Slow and steady. I like that. I think one final question. So you talked about, I think, holding cash, right, in these times. And you said, for example, retirees should use CPF Life and we should also be very prudent with our debt. But what about younger people, millennials, your Gen Xers? So, for example, should we continue to top up our CPF? And let's say if we are paying off our mortgage in cash, what should we do? Should we pay down our housing loan? What's your take on that?
Yeah, so I think in normal times and as a general principle, we always encourage people to start retirement planning early. So it's not just like near to retirement, because you want to make use of the compounding power of time. And in fact, we also do recommend in our money, our rubrics, that you put a portion of your monthly savings towards a portfolio, but also maybe some to top up your CPF, so to give yourself a discipline of saving towards retirement. Uh, I would say that in these volatile times, we would prioritize liquid assets. Liquid assets meaning cash and things that can be converted into cash quickly. So you might want to take a pause on that, but still invest that same amount, right? So I know it sounds a bit unconventional,
Yeah.
what we're seeing, but it's because of the situation. It's not the market itself. Again, it is the economy. Because cash can become very precious at some point. And uh, paying your mortgage, for example, what you can do is that you can start to use more of your ordinary account to pay the mortgage and the monthly installment, but keep that amount that you would have used in cash. Don't spend it, but save it and keep it in cash. So this is nothing to do with the mathematics of compounding and all that. That is all still there. But it's about starting from your needs and your risk, that you reevaluate and you build up that cash buffer for needs. So it's not investing as such. It's not about comparing rates and investing, comparing return, headline return numbers, and whether you should invest or not as the barometer, or as the parameter to decide, but about the safety first in this situation. On the housing loan, I think I've never really advocated that people should pay off their housing loan lump sum, because you can't eat the bricks when you need cash. So I would say that yes, you might save on the interest in the long term, but in volatile times, again, your cash can become precious. So I would say really keep that in liquid places. Yeah. Rather, and anyway, for mortgage debt, is actually quite low cost debt. We actually count it as good debt. So instead of paying it off lump sum, why not take advantage of the investment opportunities that can be afforded, including during this time, if you have excess cash?
I thank you for that reminder. I think it was very important for us to remember also that the markets are volatile now, but this also affects the economy and our job security and whatnot. So that reminder to keep cash as a buffer, that's really important. And I think that's all for today, right, Shinting? So thank you so much for tuning in. If you like more of this content, subscribe to our YouTube channel or follow us on our social media channels at Money Hour SG. We'll catch you soon.